Welcome everyone to Tax Tips for Biotech Startups. I'm Jamie Sweet. I'm the Associate Director of Education and Entrepreneurship here at Pennovation Works. For any of you who don't know, Pennovation Works is a 23-acre site with a distinct blend of offices, labs, and production space developed by UPenn. We support innovators, entrepreneurs, and industry partners who are engaged in solving real-world problems. We are excited to have John here, partner in charge of the National Technology and Life Sciences Group at EisnerAmper. And I will now pass it over to John, who will be presenting.
Terrific. Thanks very much, Jamie. Can you hear me okay? It's all good? Terrific. Yep. So as Jamie mentioned, I lead the technology and life sciences industry practice for Eisner. So we're a full service accounting firm. We do outsourced accounting. We do taxes, audits, consulting, wealth management services. And we've been doing that for about 70 years. We have offices around the world. And our tech and life science practice is one of our pillar industry groups for the firm. We serve over 6,000 clients across the world, ranging in size from early stage startups all the way through public companies, with the middle of the bell curve being sort of a Series A sized company. So just sort of getting their process started. So we help them all the way through their process, and the common thread of our whole practice is watching companies go through that entrepreneurial journey. So that's sort of the fun part. We've had a great relationship with Pennovation for many, many years. We've helped them with similar types of programs in the past, and with a number of the portfolio companies. So that's always been terrific as far as that goes. So today's program, what we talked about is just a very short, like a little primer on a couple of tax topics that early stage biotech companies should be thinking about. So I have a very short slide deck we can go through, and then we can open it up to some questions to try to stay on target here and finish within the 30 minutes, so the guy doesn't come in here and throw me out of my room. So, so with that, I will share my deck here, and hopefully this will work. Okay. Can you see the screen okay?
Yes, I can.
Okay, so let me just get to the... Oops, wrong one, sorry. Okay. All right, so we shall go through and start off here. So the first question that most companies think about at the very beginning is, should I be an LLC or should I be a corporation? So an LLC would be typically appropriate for a company that is at the very start of the company. It's sort of funded by one person. So there's no outside investors. There's no plans to necessarily have an outside investor in the near term. And as a result of that, the income or loss that you have from the business would go to your personal tax return. So that allows you to have the opportunity to, if you funded the company, you also get the credit for the losses. So that could be a very positive thing. Once you get to the point where you have outside investors coming in, they typically do not want to be an LLC. So they do not want to have the income or loss of your company being passed through to their tax returns. It may be a non-US taxpayer, whatever state you're in, they may have now set up unknowingly filing requirements in the state of Pennsylvania or other places. So it becomes a little bit of a burden for most investors. So they typically prefer not to have a flow-through entity. Instead, they would rather have a corporation. The corporation pays its own tax based on its profits. If there's losses, it typically doesn't pay any taxes, but there's no flow through and no tax reporting by the owners of the company until there's a distribution or something like that. So that's a pretty powerful thing. So think about when outside investors come in, they typically like a corporation better, unless it's like someone who's very, very close to you, sort of in the friends and family type perspective. The other big reason why investors like to invest in corporations is what you see on the slide here. This is Internal Revenue Code Section 1202, which is the qualified small business stock exemption. So this is designed to help foster innovation and allow companies the time to grow and then create value for folks. So if it's a USC corporation, and you can hold this, if you look at item number 6 here, if you can hold this for more than 5 years, and you're in an active trader business, like a biotech company or some other type of technology company would qualify, and then you eventually sell the stock after that 5 years, you could exclude somewhere between 50 and 100% of those capital gains, up to potentially, $10 million. So that is a really powerful tool, right? So if you can have no capital gains for a portion of the sale transaction, that's really powerful for investors. So that's another reason why investors really like to have C corporations. Okay. So I'll stop there for a second. So that's sort of the differentiation between sort of the LLC and the C corporation. So, and that's sort of the way to sort of think about it. So the next topic I want to cover is I want to move over to the R&D tax credit. So R&D has been an area that's been obviously for innovative companies, that's integral to your business. And the Internal Revenue Code has some very specific rules on what counts as R&D. And we'll get into that in just a second. So it can be in-house expenses. You could be using an outside CRO or outside contractors. You do have to differentiate between items that are paid in the US versus abroad. But it's basically the cost to innovate your product, your processes, or your techniques. Okay. It includes also your internal people, including some supervisory folks. So those are important things as well. And of course, all your lab equipment and machinery that you're working on, reagents, et cetera, et cetera. So it's really the cost designed to help that innovation process. Okay, so you can track all these things. You should track all of these things in your accounting system so that you can track these things for year-end tax reporting. So what do you do with that? Okay, so first we have to figure out does this qualify as a qualified research project, right? So new and improved product or process. So it doesn't necessarily have to be a new molecule, or a new product. You could be working on improving an existing product, making the process better. So even things that you typically don't think of as necessarily R&D, if they are making a process better, it's at least worth asking the question. Okay. And it has to be technology, so it can't just be you can't say you're working on something that exists in nature and things like that. So has to go through the trial and error process, like any R&D activity would typically go through. Okay. If we have any software companies in the house, there could be software is also an area where you can have R&D that's being duly qualified. So as long as, again, you're doing something that there's some risk, it's a novel new software tool, then that also could qualify for this R&D activities. Okay. So just to stop there for a second. So what do you do with this R&D tax that you've calculated? So you've calculated the expenses. So different expenses go into different buckets, and there's a tax rate that is applicable for that. So depending on whether it's payroll or contractors or supplies, but roughly speaking, you can think of the R&D credit as somewhere between 6 and 8% of your domestic spend. Okay, so you calculate that R&D credit and you put that in the bank, if you would, as a valid asset. Now the question is what do I do with that asset? So if you have taxable income, and let's say your tax due is $20,000 and you have $10,000 of R&D tax credits in your bank, then you've already paid half your tax bill and you could apply it to your taxable income. So that's a good thing. For many of the companies that are just getting started, they don't have any taxable income yet, so that doesn't really help them. So instead, there is an opportunity to use that as sort of like a debit card and give that debit card to your payroll provider. So if you have U.S. employees on payroll, you could use that debit card to offset a portion of the FICA match that you have to pay whenever you pay your employees. So it's a way to get a current monetization of that credit by taking that debit card and saying, I'm going to use it to offset a portion of my payroll taxes. So that's the 7.65% match that you have for your employees when you pay their payroll taxes. So that's a great way to get a current monetization of that R&D credit. So something that's definitely worth looking into. So R&D is a good thing, right? And that is going to be helpful to us. So not quite in all cases. So this is a sort of an unfortunate story, but we'll go through this. So Internal Revenue Code Section 174 talks about how you can treat the R&D expenses for your tax return in terms of taxable income. So for 67 years, basically you could take those R&D expenses and you could deduct those basically currently as a part of your business. Okay. So that's a good thing, right? So it's designed to help innovators come up with not having taxable income. You can take all those things as valid deductions. It's designed to encourage people to be innovative and spend money to create new products and processes. So unfortunately, starting in 2022, and this got washed out with some of the legislation that was due to be passed, but then did not get passed through the legislative process. So this codicil, if you would, to the Internal Revenue Code did not get renewed starting in 2022. So then we had to revert back to the tax code that was in play before this codicil 67 years ago, which basically said that you cannot deduct those costs currently, but instead you have to add those to your asset base and depreciate it as if you would be depreciating a piece of equipment over 5 years or 15 years if it's applicable to foreign research. So you wind up with a very unwieldy scenario from the perspective of, so picture someone with a $300,000 SBIR grant and they spend $290,000 on R&D. So you could look at that and say, I've got $300,000 of revenues. I have $290,000 of R&D expenses. Oh, no, I don't. I only have 1/5 of that. So I have $60,000 of deductible expenses, and I have taxable income of $240,000. So that is a terrible, terrible answer. So everyone agrees that's a terrible answer. The SBA, many incubators, accelerators, universities, professionals have been lobbying that that's a really bad answer and they need to change that. So the Democrats and the Republicans, for the most part, have agreed that we need to put this back to the way it was and allow these companies to get these current deductions. The House and the Senate have agreed that that's what should happen also. But the legislative process, it being what it is, still has not been done. So it's sort of tied up with other bills and other matters and other things. So this situation is still unresolved. We're obviously coming up very close to April 15th, and people have to make decisions about whether they need to file extensions or pay taxes or things like that. So it's a very unwieldy situation, especially for companies that are heavy in the R&D space. So we've worked through with a number of companies some workarounds and some other ways to look at things, trying to help allow companies to continue to foster innovation and to take the SBIR type monies and other monies that they're spending on R&D and continue to progress, coming up with new and innovative products. But we're still waiting, obviously, for the legislation to be clarified. And as part of that, we're also hopeful that it will be done retroactively back to 2022. So stay tuned. We'll see what happens there. But this is something that has been, quite significant for R&D based companies. Okay, so the bipartisan deal is sort of set in place there. We'll just see what happens with that over the course of time. Okay. So I just want to mention a couple of other things, and then we can open up to some questions. So keep a watch out for various state incentives, credits, and grant programs. So there is some opportunities out there in various states. So keep a careful watch on that. Look at your local economic development authority web pages to see what things are out there and if you may qualify. Some of them have opportunities where you can pick up various amounts of money based on payroll, based on technology, based on equipment and things like that, based on funding that you receive. There's some matching funding programs. So keep a watch on that. So all opportunities for non-dilutive financing, especially in this current funding environment for early stage companies, is a good idea. So keep careful watch on that. Okay. The second bullet here is, so regardless of whether you're a corporation or an LLC, one of the things you want to make sure you do is at the earliest date that you can is make sure you get the share ownership or stock option ownership clarified, documented, signed, and put in your vault. The reason for that is, presumably when you first start the company is worth, let's call it zero. But every day it grows. So if you're going to be creating potentially taxable events to people by giving them shares or setting the strike price of an option, in theory, every day it grows to a larger number. So you want to get these things done and documented as early as you can. So this way, your key founders, your key advisors, board members, et cetera, are getting the most tax advantaged treatment for helping early stage companies. If you do get stock, you want to consider whether you want to file the 83B election, which is basically accelerating the tax event. So you're paying tax on that stock receipt today versus over the course of time when it may be vested, if it's vesting over 2 or 3 years. So check with your attorneys, check with your accountants, make sure you think through those things very carefully, but you want to get it done, documented, and put it in the vault as early as you possibly can. Okay. Same thing happens with the stock options. So they have to be granted with a strike price, which equals fair value. A 409A valuation drives what fair value is. So if you have not done a priced round for your shares of stock, then there's a lot more judgment involved. Once you do a priced round, it becomes math. So it's pretty, it's pretty determinable. And if you do a priced round, it's likely to be higher than, say, zero. So again, if you want to give people stock options, you want to get people motivated. We know that equity is a big driver of getting key people on board. Especially when you don't have a lot of cash, you're getting started. So you want to get people aligned with your long-term interests. So stock and/or stock options is a great way to do it. So do it quick, do it early, get a little bit of help from the professionals to make sure you do it correctly, and you provide a great benefit to your advisors. Okay. So I'm going to stop here. Those were really the couple of key things that I wanted to cover. Especially the R&D piece, because that's new, and the QSBS, because that's a really, really great benefit. So I'll stop and open it up to see if there are any questions.
John, I have a question about QSBS as it applies to companies that have converted from an LLC to a C Corp. Do the stock or shares have to be held for more than 5 years once the conversion happens, or does it count from time zero of being created as an LLC?
It starts from the day of conversion to a C corporation. Yes. So if your plan is to get outside capital, you may want to set up the C corporation right from the start, so you can avoid that maybe 3 or 6 months or year or whatever it is of being an LLC before you convert.
Okay, thank you.
Are there any other questions?
I have another question if no one else has questions. How, I don't know how much you can share on this, but how have companies been managing the ambiguity around Section 174 and the potential liabilities for the shareholders?
Yeah. So there's been a couple different things that people have done. So some folks have taken the I'll say the most conservative position of just adding those costs to the balance sheet instead of the P&L, and just taking the 1/5 amortization of that. That's clearly the most conservative view. We've seen other folks sort of talking about that this research is really being paid for by other people. So it's not really revenue or expenses. It's really somebody else is paying for that. Gets to be a little bit tricky. You probably need to read your grant agreement, see who's sort of the sponsor and the process. So that is probably not without some degree of analysis and risk, but we've definitely seen people taking positions like that as well. Okay. If there's no other questions, we'll stop there. And thank you very much for your attention. And hopefully that was helpful. Feel free to reach out. You can certainly get my contact information through Jamie, and happy to help.
Thanks, John.
Great.
Thank you so
Okay.
much.
All right,
Thanks,
terrific.
everyone. Have a great afternoon.
Bye-bye.
You too. Thanks.